Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back to another episode of the Apartment Gurus podcast, coming to you from Mexico. I'm calling this the Sayulita series, all the podcasts that I record here from remote on location spot. But we're still I'm still very, in work mode, working remotely here, and heads in the market, right? Like we've got two deals we're working on at my company right now at Greenlight, one in Utah and the other in Oklahoma City. And I wanted to have my buddy Jeff Rappaport back on the show here with us. I got to listen to Jeff give a presentation at our local RIA, Real Estate Investor Association, which, by the way, all of you should be members of your local RIA. If you have one, of course. There are tremendous resources and relationships to be had and discovered in those groups. In the Utah RIA and the Salt Lake RIA, I've really forged some great relationships, and even one of our partners that participates in deals with us, I met through the RIA events. So Mr. Jeff Rappaport, amongst other things, is the host of the Creative Financing Podcast, which you all should check out. Jeff is that's really his superpower, is communicating with people about seller finance options, creative financing options, in such a way that makes it easy for people to get their heads around, which is super important because, as we all know, a confused mind says no. So if you throw something really sophisticated and confusing at somebody that they're not ready for, you're not going to get very far. But Jeff has a way of bridging that gap. Also, just a tremendous expert on the market. He's been in the market now for a couple decades, Jeff, right? At
22 years. Yep.
Yeah, that's what I thought. And so he's seen a couple of cycles here, a couple of down cycles and some growth cycles. And so I'm really excited to bring Jeff back and have him share with you guys really what it's going to take to be successful in this changing market, and how much the market really is changing, how to pivot, how to be flexible, and how to be creative. So Jeff, dude, thank you so much for doing this. I really appreciate you coming back on the show.
My pleasure. Always fun to get on podcasts and chat with people, and love talking about real estate and what's going on. And so always my pleasure.
Yeah, you're a real junkie, aren't you, about real estate? We could get you on one topic, and you could probably talk and teach for hours on it. But that's one of the things I really appreciate you for, Jeff, is how much you've given back to our local Utah real estate community. And really, you're just a natural teacher, and you bring things to people in a way that is easy to get their heads around. So before we
appreciate that, thank you.
Yeah, man. Yeah, you bet. And so Jeff, before we kind of dig in, we've had you on the show one other time, and we got into your story on the last episode. So if you all are looking for Jeff's, the Jeff's story and everything else about his path in real estate, you can check out that last episode that we did. I don't have the number right in front of me right now. We'll put it in the show notes. And we'll put a link to that show in the show notes as well. But Jeff, just kind of, for those of the listeners that don't know you and didn't hear that first show, share a little bit about, your background, your experience, and your path in real estate, and kind of how you got to where you are today.
Well, I started in real estate back in 1999. I went full-time in 2000. And I started out buying single-family homes subject to. That was the goal, taking over existing debt and then lease optioning them out to tenant buyers. And as that progressed and I started accumulating a bunch of properties, I got into short sales. And this is when banks did not really know what a short sale was. So I had to educate a lot of banks about what I was trying to do. And this was back in the day where you could negotiate everything directly with banks. And so that was somewhat interesting. And I progressed. I started getting into some education, and I started dealing with commercial and land and a little bit. I've done a little bit of everything over the last 20 years. And I went through, I'm probably one of the few people that's still around that has seen interest rates this high before. And I think people are in a panic about it. And mostly because interest rates have been so low for so long, and it was like a fairy tale land with what we've been going through for the last 4 or 5 years or more. That now we're going to start to get back to a more reality, in my opinion, where properties are so overpriced right now, and these rising interest rates will definitely affect affordability, both apartment wise and commercial wise, where these 3-4 cap rates aren't going to fly much anymore when interest rates are 6+, and and single family, where affordability is just unreal in a lot of markets across the country. So I went through the crash of 2008, and I learned a lot. What I learned is what not to own during a crash, and I owned some land, and I owned some high-end renovations, and all things that you don't really want when things fall apart really quickly. And basically ended up losing everything that I had built for 8 years. And got out of real estate for a little bit, tried to regroup and started over with nothing, and did that about 2014. And I've done wholesaling. I just closed right before this recording. I just closed on a mobile home park, and we just wholesaled some storage units. We just wholesaled the 68-unit apartment building. I do a little bit of everything, and creative finance is my niche. It's where I started 20 years ago, and I've been using it through the craziness of the last 5 years, but now there is a huge opportunity. And it's funny, creative financing is being treated as if it's something new, like it's a new strategy, right? Sub 2 or
right.
And it's like, it is not new. I've been doing it for 20+ years, and my teachers have been doing it for 10, 15 years prior to that. And it's not something new. Yes, there may be some tweaks and changes to it, but most of the strategies have been around many, many years. So That's kind of me. We work nationwide, and there is absolutely a commercial component to our business. Actually, I kind of like commercial more than residential. Paydays are much bigger, and some of the things that will affect residential don't necessarily affect commercial. So that's a little bit about me.
Yeah, when you say commercial, just for the sake of the listeners, you're referring to, amongst other things, commercial multifamily projects, right?
Apartment. So we focus mostly on 4 assets: apartments, storage, mobile home parks, and RV parks. But we'd look at anything that brings in. I like industrial too, but I'd look at anything. But office is a little. I'm a little leery about office. Retail would be a little bit borderline for us as well. But we'll look at anything that has income.
Yeah, and you were talking about in 2008, you didn't use this phrase, but kind of how to not get caught with your pants down in a downturn that is really sharp. It seems like these last downturns have been really sudden and sharp. And it seems to me like, really, to summarize, you want to be owning cash flowing properties as they sit at, right now, today, and in a recession or a downturn. And you don't want to be holding on to speculative nature properties like a land development deal, renovations, flips where you're speculating that you're going to be able to sell for X number of dollars. What happens when the debt market shifts like it has this sharply is that X number of dollars changes, unfortunately. And that was a good lesson for us right in the middle of this last growth cycle when we got into commercial multifamily for the first time. We really saw the magic of owning cash flowing properties. And now that my team and I have a portfolio of almost 600 units. All of them are paying the bills, right? All of them are paying the debt service, they're paying the expenses of the property, and they're paying our investors as well. And that's where you really want to be. And if you're looking to continue to acquire in this market, you need to make that happen. The days, at least in my opinion, of responsibly doing speculative value add projects, say in a market like Utah where the pricing's so high, that was great a year ago, and you could buy for X at a 4 cap and sell for Y at a 4 cap and make some good money. But those days have changed so much. Interest rates have spiked by over 2 points, I guess, at least. Yeah. So kind of 30,000 foot view, Jeff, what are you seeing that concerns you? What are you seeing in the market that maybe gives you, some hope, some optimism for the overall health of the economy or the overall health of the housing market? Both locally and nationally. What trends are you seeing?
What I call right now is a transition period, which is the period where prices need to come down based on affordability, based on interest rates, based on market cap rates, the various different ways that we look at properties, that prices have to come down. However, sellers, whether residential or even brokers of commercial properties, don't all want to believe it yet. And so they're still in the mindset, well, things could change, or things haven't changed like they really have. And so we're kind of in this conflict where prices need to come down, but not every seller is aware of it, or maybe they're aware of it, they're just in denial.
Yeah.
So that's what I see the most, and certainly here locally. You see some motivation all of a sudden. You see you're seeing more inventory, and when now all of a sudden properties sit for 60 to 90 days or more on the market, as opposed to getting multiple offers within days, sellers and or brokers will start getting the message. And if you go on like Crexy or LoopNet and you look at properties right now, you'll see a lot of properties that have been listed for 150, 200 days. And if they didn't sell during that time frame, and they haven't reduced their price significantly, they're never selling based on that price, or at least not anytime soon. And I personally believe that interest rates are going to continue to rise. I've heard some different rumors that, this was some hearsay through someone that I know personally locally, and he was talking to his broker and a number of realtors who believe that interest rates will start coming down in January. But that defeats the real purpose, in my opinion, of why the Feds have been raising interest rates, right? To curb inflation and to get some equilibrium back in real estate, because all things were just go up, and I mean up, right? Like never seen before. Right. So, and every market is different, right? We have some houses. We bought a portfolio of houses in Ohio, and we're still selling them, and they're selling within a couple of weeks. But they're 200,000 or less, and that the rise in interest rates probably are, they're still affordable, and people still need a place to live. So I think it's going to be really interesting to see how long it takes before we really see us get back to an equilibrium in the real estate market, where it's not necessarily a buyer's market or a seller's market, it's a stable market. And I think we have a ways to go, but like in Utah, I expect to see prices really come down, and it might not be all at once, but it's become a very unaffordable market. And for both commercial and residential. And when you're seeing these cap rates, where stuff was seriously being marketed at 2.5, 3, 3.5, 4, and I don't know, Tate, if you saw this, but I feel like B and C type commercial apartments, right? Started getting lumped into there was no more 7 and 8 cap type properties. It was basically 5 and 6, and so now all of a sudden I think you're going to start seeing that expand again. And it wasn't just apartments, it was storage. I mean, mobile home parks, which should be basically starting at a 7, 8 cap, were being lumped into 5, 6 caps, and so things got really, really inflated. And I think it'll be really interesting to see. So many people got into real estate, and I see this all the time, that people jump in as we move toward the top of the market, right? Everything's going up. People think that it's a good time to get in, and then they jump out when prices start coming down. What we experienced over the last several years is a lot of new investors that may have done everything wrong and still made a lot of money. And the market just kept them in the deal, and made them money because it outpaced any mistakes. Now we'll probably weed out some of those newer investors, and even apartment buyers who were buying at a really top price and are going to be forced to refinance here now or in the next couple of years could really be in for not a good experience, because if you have to refinance at 6.5%, 7%, and you bought at the top of the market, that could become a problem cash flow wise. So I see a lot of different factors working here, and it'll be interesting to see. It is a different situation than 2008, but I still believe that we will see something similar in that we will see prices come down in some markets sharply, and we'll see how that kind of transpires. And the one thing that I can't quite grasp yet is what's going to happen to rents. And
so I was just about to ask you about was rent growth and downward pressure.
Yeah, it's so hard to figure this out, because right now it is more affordable to rent than it is to buy by a significant amount, right? So,
right.
And which would indicate to me that that'll give landlords an opportunity to even potentially raise rents, because there's not much more. There aren't any alternative choices for them for these buyers or renters, and so. But at the same time, rents are pretty high, probably higher than they've ever been, and at some point they're going to adjust. And I would say if you are in the BC type rentals, apartments, that more than likely you're not going to see a whole huge change in rents. If you're in the A, that might be a different story. And as things become less, if we continue to deal with inflation, we continue to deal with affordability issues, that's what's going to change, is people are going to forego living in the big house or the really nice apartment, and they're going to downsize, and they're going to get into something more affordable. So same thing that we saw in 2008.
Yeah, and this speaks really to this whole concept of how investing in some multifamily asset classes, like Jeff was saying, B's and C's, is really a recession resistant proposition. Now, be careful not to say or think recession proof, because there's never any guarantees. And we see black swan events and things that
COVID
you just
moratoriums.
Geopolitical stuff, the whole 9 yards. And so there's never guarantees. However, historically, you can look back at the performance of multifamily and really get a grasp for how it performs during economic downturns. And default rates they're a fraction of what they are in the single family space. About 10% of what single family defaults look like. And it really speaks to this whole point that Jeff was just making about how rents, depending on the market and where you are not typically going to come down, especially in B's and C's during an economic downturn. So if you bought right and you financed right, you should be in good shape as long as you can wait it out, right? And that means having fixed rate debt, having a cash flowing property that's paying all the expenses and debt service and everything else. So yeah, it's such if you're out raising capital, if you're talking to people about getting involved in real estate at any level, that's a really important concept to have your head around and be able to explain to people in a way that makes sense. Because once you do explain that point to people, they're like, oh yeah, that totally makes sense. And even the A-class stuff, I mean, if a family of 3 or 4 can't afford to live in an $800,000 house, chances are they may, if that's something they were considering, they may be able to live in an A-class apartment. And the more demand you have for that, the more stable those rents are going to be. So let's start with Utah and kind of work outward, Jeff. In Utah, for those of you that aren't here, or in Utah, we've seen just an incredible amount of appreciation, especially in the last 5 years. Probably a doubling of value in 5 years. Is that about right, Jeff?
I would agree.
Yeah. And we can speak to all the reasons for that. Just a flood of money that was printed and is in the market. Low interest rates.
Out of California, probably speaks the loudest. And we have jobs. We create jobs here. So. Yep.
And cost of living, aside from housing, is reasonable. And like you said, good jobs. But this exodus from California in particular around Utah, and then you look at the Sun Belt and the exodus from the Bostons and the New Yorks of the world, is really a thing, and especially post-COVID, now that people are so adapted at working remotely and working from home or working from anywhere, people are picking places to live based on lifestyle and not necessarily based on jobs anymore. And, when you were speaking the other night, you were talking about a scenario where a family that has a house in the Bay Area, say, that's worth a few $1 million, can move to Utah, have a much higher kind of standard of living, I guess, with 3 times the house for 40% of the price. They can move from a $300,000 house to an $800,000 house and upgrade almost. So that's what we're seeing in Utah. Do you see that demand continuing, softening? What are you seeing right now as far as that trend goes?
It's Utah, and I would group a few other states into the Utah group, which would be Idaho, Montana. That they've all experienced great growth over the last few years, and I think all for similar reasons. And however, like Idaho is probably one of the most overpriced markets in the country right now, based on things that I've seen, read, and which was Utah not that long ago. And
right.
The thing that's kind of questionable is we still have growth. Like all the things that are good that would continue to attract people to move here are in place, right? We have low unemployment. We have some bigger software type companies that have made their way to Utah. It's a beautiful place to live, good place to raise a family. Cost of living is reasonable. Property taxes are very reasonable. There's a lot of good reasons that would make it so that nothing should really change here, except for one really big one, and that's the affordability.
Right.
Now, the affordability is that it is not, I couldn't really give you any numbers because I don't really know off the top of my head, but I would think that the state of Utah has become so unaffordable that we may start seeing a lot more defaults based on that people are having a hard time keeping up. And that's the one thing that somehow, some way has to get resolved, because yes, the people that have moved here from whether it's California or the East Coast, they're probably fine, right? They're used to that kind of expenditures for living. But the people that live here, that have lived here for years, they are not. And unless jobs and wages can keep up, which they have not, and it's going to put a lot of pressure on what's going to happen in regards to that. So we have these conflicting pressures from both sides, and it'll be interesting to see how it plays out.
And it just makes me think, as I'm listening to you, it makes me again think about pressure on rents, like, because the affordability in single family, that issue is, like you say, it's huge. It's the big elephant in the room out here. And it's the natural place to go is like, okay, that means people are going to be renting. People at default have to have a place to live, and they're going to be renting. And it makes me feel like the proof of concept we're going to about to see the proof of concept behind what all the people like me I have been learning and talking about for the last 5 years in this space, which is the fact that we feel confident in the multifamily space in its terms of its ability to maintain solvency and stay relatively on budget. Now, if cap rates decompress like they probably should and will, the values might not hang up to where they are right now. But if you batten down the hatches, so to speak, and are prepared to weather the storm for a year, 3 years, 5 years, whatever this downturn is, the last one, it seemed like it took 4 or 5 years before things started to kind of pick back up again. If you're prepared to do that, you're going to be in good shape. Like you said, Jeff, if you're on adjustable rate, floating rate, arms and bridge loans and that sort of thing, it could be pretty tough. And that really kind of takes us into, a big thing that one of the reasons I wanted to have you on the show, is to talk about, like, how do you help people that are in a situation where they're over leveraged and they've got a note that's coming due, or they've got an adjustment that's coming up that's going to make the property insolvent. What are, how do you, Jeff, go about, what's your internal dialogue? What are you thinking strategically? And how do you go about talking to, owners about possibilities?
So you're referring to creative finance.
Creative financing.
Assuming.
Yep. Yes, sir.
Well, and I'll give you a really quick example because this is what's going to happen. But let me address something that you just said. You said someone that might be over leveraged or in a situation where they need to get out. Those are going to be really interesting deals in the commercial realm, in the apartment realm, because numbers still have to work to make it. You've still got to be able to generate income, right? NOI.
Yeah.
And
right.
So it'll be interesting to see what kind of situation people find themselves in, because as much as creative financing can help, it can't solve, underlying debt issues. And so we'll see how that kind of plays out. But think about this for a second, okay? If you were asking, let's say, $7 million for an apartment building, okay? And you are, you'd love to just sell it and get cashed out of it. You've got a bunch of equity, and maybe you're not super motivated. The property brings in income, but you're a tired landlord. You just don't want to anymore. It's not like, maybe you're self-managing it, which, who knows why, but
right.
All the reasons why people eventually exit, either a property or real estate in general. They want to retire, whatever. Yeah. So you don't have to be truly motivated to be open to terms. And let's say this property is set on the market for a few months now, and there's not a lot of interest. And the reason that there's not a lot of interest is that they're still basing the pricing on 3-4 months ago rather than what's gone on right now. So buyers are like, you're overpriced. And maybe they're starting to see offers at 6 million, 6.2 million. And the seller's like, oh man, I don't want to give up $750,000 or $1 million in my equity. I just had it 3-4 months ago.
Yeah.
So now really for me, what it comes down to is, if I was to go to the bank and get financing, Tate, well, what in general, what kind of interest rate do you think you could get on an apartment right now?
Low end high 6s and high end high 7s.
Okay. So we're talking, if you put down, let's say 20%, 25% on this kind of deal, you will be looking at a $30,000+ a month payment. And let's say that the rents, the NOI just does not support that kind of debt service, right? So it kind of, hey, it doesn't really matter what you think the property is worth anymore. It really matters what the cash flow will be. And so now if we can go, and if I could come back to you and say, look, Tate, I know you're asking $7 million, but I think we both know that getting $7 million and what's going on right now in what we're dealing with as far as interest rates isn't going to make sense, because debt service is going to be this, your income is that, and if we take out expenses, there's no income left. And so let me ask you, would it make sense if I can get close to your price? Would it make sense if you would take some payments over some time? Would it, is that more important to you to get closer to your price and get a steady stream of income like you do now? And actually even get some tax benefits of doing so while you are getting these payments? And the answer will become more and more yes, because that's the only solution they will have other than significantly reducing their purchase price. And now the reason why this becomes so important is that, one, I don't have to go to the banks and be held hostage to high 6s to high 7% interest rates, which are potentially killers right now. Right. And so I also will what kind of down payment are you looking at when you're going to the bank? Minimum.
Oh man, 20, these days, 30% minimum that I'm seeing right now. Yeah, because as the lenders start tightening up, they want you to have more skin in the game, right? That's how they protect themselves. So, but what if I say, look, I'll pay your crazy price, and we're normally in agreement, right? Like, I'll pay your crazy price, but I'm going to put down less money. So let's say I'm going to put down 10%. And I'm going to modify my payment so that, hey, I'm not basing it necessarily on an interest rate. Maybe I am, maybe I'm not. But if I can modify that payment where $35,000 doesn't make sense per month, but $25,000 does, now I can modify that payment to make this a profitable deal, a cash flow deal, a super good cash on cash return. But probably the thing that I do even more than all of that is that you syndicate, don't you, Tate? Yes, sir. You bet.
So if you're syndicating, you're raising money, right? You're paying everyone a portion. You're getting a piece of the property, however big it may be. And then at some point, the goal is in the next 1.5 to 5 years that you're going to refinance that property out, right? Pay everyone off their percentage. Well, what if now, if you could just borrow some of the down payment, you can own the property either all yourself or, have one partner for a percentage and you maintain the majority of it. That would be a lot better, wouldn't it? A lot more profitable. And so this is the way that we can kind of counter what's going on in the market and still come close or even pay sellers what they're asking by modifying, and this is based on, hey, they have small debt or no debt. You're also going to start encountering, hey, more assumable mortgages where you can take over low debt and, depending on for how long and what rates and whatever, but there's going to be a lot more assumable type low interest kind of debt that you can take over. So to me, that provides you, me, your listeners, with this huge opportunity. And because most of these sellers are going to have a difficult, if not impossible, time selling the properties for the price that they truly think it's worth. And when they start looking at the numbers, it is significantly less. And I'm not talking about market cap rates or anything else. I'm talking about if I go to the bank and get financing, that this won't cash flow. And if it doesn't cash flow, I'm not buying it.
Yeah. And the bank won't lend on it if it's cash flow constrained.
That's right.
If you've got, usually the bank's threshold is 1.2 or 1.25 DSCR, debt service coverage ratio. And yeah, I mean, if it doesn't work, it's not going to work for them, and it certainly isn't going to work for you. What in the commercial space, Jeff, how savvy are most owners and or brokers around this stuff? In other words, how much educating do you do? You know, how many times when you bring this conversation up are people already ready to talk about it or have never heard of it?
It varies, definitely.
Yeah.
And so normally so brokers know more than owners for sure. But
yeah, I've
had plenty of brokers say, "Oh yeah, I totally understand that," and then they see something and they're like, "Wait, what's this?" So there is, and when you ask about how much do we try to educate? Very little. We try to keep it so stupid simple that you know, and really all it is, hey, we want to make you the bank, and we're going to pay you out over some time, and there's some benefits to you by doing so. And keeping it very, very simple. When we create our LOI, our letter of intent, that what I like to do is make multiple offers. And I'm going
Huge point here.
I'm going to give a seller a number of options. And to be honest, a lot of these properties that I've been dealing with for the last 2-3 months, they don't even get any kind of cash offer or cash out offer. And we tell them that up front, like, hey, you're asking too much. There's no way. If we were to come with a cash offer, you'd be insulted. And now if they truly ask for it, then we'll give it to them. But there are plenty of LOIs right now that we're not even making cash offers. So not even a possibility that we're going to cash them out. Now it's about how do we structure the terms that we can create a win-win situation. And there's going to be some pushback. I was in a conversation a few weeks ago with a broker and a seller, and we talked to the broker, and he told us a purchase price of 10 million will probably get this done. And I said, okay. And so we made some offers in that $10 million range. And then they countered us at 12 million with interest only payments. And I'm like, what is this? And with like $2 million down payment, I'm like, well, when did you become Wells Fargo or Bank of America? Because that's not going to work. And sometimes it's so funny, they counter you, and their terms doesn't create any cash flow for you. And so now it becomes more of how do you expect us to make any money with those terms? Because you're the one telling me, here's your rents, here are your expenses, here's your NOI. And and now you're telling me here's the payment that you want. Now tell me how that's going to work. But you're still going to have people push back, and they're just, remember, we're in that transition period. As we get through these holiday months, more and more people will start to realize that, hey, things have changed, and you're going to see prices come down and come down. or people are going to be much more open to the creative finance techniques as opposed to trying to get cashed out.
Yeah. Yeah. And so listeners, this stuff's gold. And if you want to learn more about, I mean, it's kind of like anything else, like when you go to a foreign country or, someplace you haven't been before. Really, this is just a matter of learning how to speak the language, and Jeff does such a good job with this. And it's why I wanted to have him on, is because he does keep it simple and it makes it easy to understand. And if again, Jeff's podcast, the Creative Financing Podcast, right there in the title, it says it all. If you want to learn more terminology, conceptual stuff, that sort of thing, how to talk to people, check out that podcast on Apple Podcasts or Spotify or any podcast platform, because you want to kind of immerse yourself in the languaging of this stuff, and then it becomes much easier to understand and much easier to explain to people. And look, we assumed loans, 2-3 years ago. We got new fixed rate loans 2-3 years ago. We've never done a subject to, or, quote unquote seller finance, which, by the way, would you agree that that's not a term that you want to use when talking to a seller?
Either one. I don't like calling it owner finance, and I definitely won't say subject to. If I was looking at taking over existing debt, I would say, look, we can buy this property and we'll pay you out, whatever the equity is that we decide on, and we'll just take over that existing debt. And they say, oh, you're going to assume it? No. We'll just be responsible for making that payment. If we're doing, is that handled with an all-inclusive trust deed, like in residential? It can be either subject to or a wrap. Yeah. So it could be either an all-inclusive or a wraparound mortgage, depending on where you're at.
Yeah. So for listeners, that's just a situation where you're leaving the existing debt in place. You're putting a new note on the property that the seller is providing that quote unquote wraps that existing loan into it. And they're making payments on that, or the escrow company is making payments on that existing debt as well. Well, geez, I hate this. We're already starting to bump up against time. You mentioned earlier that you see interest rates continuing to rise for a bit. I've heard a number of people say that we're kind of at the end or getting close to the end. Maybe that's just optimism, wishful thinking, that sort of thing. What's making you think that we've still got some ways to go here?
Well, let me ask you a question. Why do you think interest rates have been increased? What was the goal?
Yeah. To fight inflation, right?
And I think in secondary, is to bring some equilibrium to the real estate market, right? Because things have gotten a little bit out of control, very one-sided. And have we defeated inflation yet? No. Have we gotten any equilibrium in the real estate market? No.
Not really, yeah.
So to me, it's like if we started reducing interest rates now, I'm not sure why we increased them to begin with. And it defeats the purpose, in my opinion. And will interest rates stay high? I don't think that they're going to be, 8-9% for a long period of time. But the goal really is to get things back in a more equal state. And we haven't done that yet. Inflation's still out of control. And until we start seeing that change, I don't see why interest rates would come down. Now, they might drop, 1 week a little bit, and the Feds like to make you, they don't want you to be shocked all at once, right? They like to drop it a little and then they'll raise it. But overall, for me, rates are going up, and I don't see them coming down in the near future yet, not until we see some changes.
So in your world, does that just point to doubling down on what we've been talking about here?
Yes.
Creative financing and creative structuring. Yeah.
Yeah, yeah. One of the things that, and I know we're running out of time, but I find this a lot is that, I think real estate investors get a certain idea in their mind, right? So, and tell me if this is true, Tate. As an apartment buyer, you're looking for value add, right?
Yeah.
And what you want to do is you want to buy at a good price. You want to do whatever value add, increase rents, deferred maintenance, better management. You're increasing the value. And then you're basically doing the BRRRR strategy, right? Where you refinance and able to pull out most, if not all of your money, and maybe even plus some, right? That's the goal, right? With creative finance, we can create a number of different goals, and they won't all fit the same buy box, right? So we can go after turnkey type properties. The value add might just be, hey, rents are on, they haven't raised rents in 3 years, but there's little to no deferred maintenance, and if we structure it right, would you still want that property if it's good cash flow and you could get in with a reasonable down payment and you don't have to look at refinancing at any point, anytime soon? Would that still be something that you would say, hey, it might not be exactly what we do or go after, but how can we really not look at this, because it would be a great addition? And I think it's funny. We wholesaled an apartment like a month ago, and it was that. It was not a BRRRR strategy. It had huge upside, huge value add, because rents
the management.
He was self-managing it. A lot of the properties, a lot of the tenants had pets. There was no pet deposits. There was no pet rent. The rents were at least $150 on average below what they should have been across the board, right? But it was built 5 years ago as new property and well taken care of, and in an area where the population's really low, but right by a university, and it stays full all the time. There's like zero vacancy. And we wholesaled this property. Should have kept it, but I was shocked that how many people responded, which were not very many. And this was principal only payments for 10 years and like 12% down payment, and super good cash flow after year one. And at the end of this, it was like a 10-year balloon, and the end you'd owe under 4 million and it'd probably be worth 10. And I'm like, it really hit home that not all investors can think outside of the box. And they look for a specific type of property and they want it to fit their buying criteria, when in reality, if creating passive income is your goal, that there are a lot of things that can fit your buy box or your buying criteria, especially if you're using creative finance. So I just wanted to throw that out there because I found that really interesting.
Real quick, when you propose a new note, like in that situation, it was a 10-year balloon, is that pretty typical term that you would propose? 10 years, 5 years, 20 years? How's that look?
So it's more of a question to the seller or the broker that I want to get an idea of. And, I just made some offers, and 5 years to me seems too short right now. We just don't know where things are going to be, both interest rates and, where are we going to be in 5 years? What's going to happen? I'd rather have a 7 or 8 year term minimum, but you can structure things in such ways that, hey, if we're at like 70%, loan to value in 5 years, 5.5 years. And we were able to do it with a down payment that's, pretty small. I'm okay with that. So, but I was making 3 years to 5 year term offers, 3-4 months ago. Unless it's more of that kind of value add type thing where you're looking at refinancing, to me that's too short. So 5 years would not be my choice. 7, 8, 10 is more what I think is reasonable, but I'll try to make it worth their while to carry even longer, 15, 20, and just make it worth their while to do so.
Yeah. Jeff, fascinating stuff, man. You're a wealth of knowledge, a wealth of ideas, strategy, and market perspective. Really valuable stuff. Really appreciate you coming on. For listeners that want to, obviously your podcast, the Creative Financing Podcast, listeners, check that out. You'll learn so much more about this sort of thing. Any other good places to reach you, Jeff? What about getting on your buyers list for your wholesale properties?
Yeah, you can just email me at Jeff@, weofferoptions.com. And I'm happy to chat with people. And if you need some guidance, direction, I'm happy to do so. So just reach out.
Great. Well, thank you so much again, Jeff, for coming on and sharing with us. Really appreciate it. I know you love talking about this stuff, but it's great just to be in your space and get to listen to you talk about all this stuff. So
I'm jealous because I'm looking at your background and you're in Mexico and I'm in Utah and it is gray skies, stormy, cold. Yeah. It's like, I think I got to start going on the Tate Siemer type plan here. So
it's amazing post COVID how much you can do digitally these days, and working remotely is a real thing. The only thing I can't do from here is go visit our properties, but everything else is pretty doable. So
awesome.
Good stuff. Listeners, it's been Jeff Rappaport with the Creative Financing Podcast. Check that out. Send him an email if you'd like to connect. Jeff at what is it again? Something
we offer
options. I couldn't remember the offer. So weofferoptions.com. Jeff is JEFF. So Jeff, thanks again. Listeners, thank you for listening to the end of another one of these episodes. We have some opportunities right now at Greenlight for passive investing. If you know of anyone that might want to get into apartment ownership at a fractional level, we've got a couple different things we're working on. So by all means, reach out to me at investwithgreenlight.com if you feel so led. And with that, we will see you all on the next episode. Take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.